We are doing this in part to raise money for Coney Island Prep, and I think that link, if you'd like to donate, is still live on our conference website. So please don't forget to do that. I'm really excited to be joined today by two specialists in the institutional allocation space. Roxton McNeal comes to us from the UPS Investment Trust, and Corey Hoffstein from Newfound Research. So let's begin by taking a high-level view of the portfolios that you're managing. What are the objectives, and how are you managing to those objectives?
I guess I'll start. So we are a pension fund. So our objectives, we manage three defined benefit plans that are wrapped in a trust for UPS. The objective there, obviously, is we just entered into a glide path strategy. So our objective is to make sure that we cover the cost of our liabilities. So a pension is nothing more than you have assets up against a big short bond, which is what your liability structure is set up as. So our goal is, being underfunded, your goal that you take is to earn the yield that you would earn, the discount rate that accrues on your liability. You have your assets to earn that, plus a little excess return that you have to use to recover from being underfunded. So at a high level, that is our objective, is to make sure that we beat the return of our liability, and we earn an excess return to defease the liability over a certain amount of time. And in our case, it's 20 years is the horizon that we take when we're using all our modeling to create that.
So at Newfound Research, we are a quantitative asset management firm who is really dedicated to helping investors proactively navigate risk by introducing unique alternatives, as well as unlocking the benefits of diversification with those alternatives through a process we call return stacking. We primarily focus on working with financial advisors. So the portfolios that we build on behalf of those financial advisors are usually going towards mass affluent, and on a dollar-weighted basis is primarily pre and early retiree. So it's a very long-winded way of saying most of them just want a 60-40 portfolio. That tends to be where they end up. And then they often are following some sort of target date glide path through retirement into more conservative options. So we build primarily different portfolios that are objective-based and risk-targeted. If I were to sort of sit here and say the big differences between what I do and what Roxton does, it's that Roxton manages $50 billion and I don't. So that's the big summary there.
Okay. So looking back over the past 10 months and now looking forward, how has your allocation process changed, if at all, this year? And does, on a year-to-date basis, matter to you when you think about managing your portfolios?
I'll jump off. Our portfolios haven't changed at all. I think the appetite for what we do has changed among advisors. Again, going back to most of the advisors that we've historically worked with have been very comfortable in a traditional 60-40 portfolio for the last decade, 2 decades. I actually kind of laugh. The 60-40 portfolio, if you ask people where it comes from, why is it so prevalent in the industry, no one can actually tell you where the origin of the 60-40 portfolio comes from. People think they know, but if you ask them for hard evidence as to where did this concept come from, we've all just sort of emerged on it as an industry somewhat naturally. And I think we emerged on it because we had the wonderful negative correlation between stocks and bonds that persisted for so long. And it was just the right amount of equity to get that nice growth over the last 30 or 40 years. And people are struggling this year to figure out whether the 60-40 will continue to work going forward, or whether they do need to think about doing something different, which might be going beyond bonds to manage risk. Lots of clients are getting more interested in using option-based strategies as a further diversifier, as well as reevaluating alternatives that they may have looked at in the 2010s, things like managed futures that they discarded, now thinking about creative ways of reintroducing them to their portfolio. So by no means are our clients ready to wholesale throw out the 60-40. But they are starting to make those incremental changes in preparation that this could be not a one-year event, but from a true correlation change between stocks and bonds, a decade-long event.
And Roxton, for you? Does
Yeah.
this disruptive year change how you think or do anything in your portfolios?
Yeah, fortunately, we're a pension, and our biggest strength is the fact that we have a large balance sheet and we have a really long-term time horizon. So everything that we look at from a strategic asset allocation perspective is long-term. So once a year, I'll rerun an ALM study using your basic capital market assumptions that you get from the banks or actuaries to come up with what the next target should be for our strategic asset allocation, but it does not change all that much. From a tactical perspective, though, I think that the changes that we make as a pension, one of the free lunches that we get in addition to diversification is rebalancing. So as we look at the rebalancing between return-seeking assets and fixed income, we'll do that on a tactical basis within the year. But from a strategic perspective, our investment thesis is pretty static.
Okay. And what would you say, after the 10 months we've experienced, what's your greatest concern looking forward? How are you managing to those concerns? I know it's a loaded
Yeah,
question.
that's a big one. You know, my biggest concern personally, and it plays a little bit into how we manage portfolios, but it's more of a philosophical concern, right? About the idea of, we went through a fairly traumatic event with COVID, both from an emotional perspective, but from an economic perspective, certainly had monetary and fiscal policy not done something, it would have been an incredibly traumatic economic event. The idea that we can ultimately engineer our way out of one recession without avoiding costs at some point, whether that's nominal economic decline or high inflation, to me, if we truly believe that we can do it, it raises the philosophical question of, what are we earning a risk premium with these assets? Like, if we can engineer away the economic left tail through monetary and fiscal policy, why should stocks earn above the risk-free rate? And so the way I sort of look at the current situation is, we have to eventually realize some pain. It's just a question of what's the duration of that pain. Can we smooth it out over a multi-year cycle? Do we have any control whatsoever? I don't know. But my personal viewpoint is, the pain has to come out somehow. I think we're currently living it more in the inflation side than the economic growth side. It'll be interesting to see if it plays out in the economic growth side. But I think if it's going to come out in the inflation side, it does mean continued prolonged high correlation between stocks and bonds, re-emphasizing the need for some other defensive assets in the portfolio.
Roxton.
Yeah, that's a great question, and similar to Corey, for me, the risk is how the relative performance between return-seeking and fixed income actually play out. For me, it's funded status. So if you were to quantitatively model my profile as a glide path, it's a call overwrite. Pensions have asymmetric risk to the upside versus the downside. So they're essentially selling the upside away. A sponsor can't claw back an overfunded pension, so they don't want you 110% funded. They want you 95, 96% funded. But at the same time, they don't want you 80% funded either, because of the cost, the PBGC premiums that get associated with it, both on a fixed income and variable cost, and just the additional risk that the sponsor may have to contribute some operational cash flow, heaven forbid, into a non-operating defined benefit plan. So there, from that perspective, it's really which one outperforms the other. So all we really are as a pension is a matching liability plus an outperformance short put option on the rest of our assets. That's all we are. So if you look at ourselves as a short put on an outperformance option, return seeking minus fixed income, then you can see exactly what we have to mitigate. We got to mitigate, so we have a short put profile, which means we're short gamma. So we have to hedge against that short gamma profile, which means there's two ways we can do it. We either go out there and sell that option directly. We can sell that put option to an insurance company who wants it and it's valuable. And if we can earn an implied higher than the realized that we own, our profile is a realized volatility profile. If we can sell it to them for a higher implied than the realized, then all I did was I mitigated. I have an insurance premium that I created for my glide path. That's very rare, and we're working with trying to sell that option, but there's a lot of negotiations associated with that. So what can we do otherwise? We can go in and we can buy convexity, or we can delta replicate convexity, and that's the path that we chose. We actually delta replicate convexity, and we delta replicate convexity in the numerator, which is your equity, your return seeking, and we delta replicate convexity in the denominator, which is your rates of the outperformance option. And as long as we have that framework, we're able to understand what our risk profile is and exactly what we're doing against that. So we'll set a strategic asset allocation. I'll carve out a big piece of that to actually allocate to an outperformance option profile. And then I'll use derivatives and overlays within the plan itself using quite a bit of leverage to replicate, the delta replicate what the profile is that I own, which is a short outperformance option plus a liability matching portfolio.
Okay. What are some of the exposures that you like that are hard to access now?
No, sorry.
What do I like? That's a good question. I think we're able to get most of what we want. I'm really simple when I set strategic asset allocation. I have my portfolio managers make sure they get me beta, and that's all I care about. Now, they're incentivized to go out there and earn me alpha on top of that beta, but honestly, I could care less. If you look at the way that we're structured, what I own is, if you look at a simple attribution model, what I own at the total group trust level is the allocation decision. Here's your strategic asset allocation. Are you going to be over or underweight return-seeking assets, private equity, real estate? I own that decision, and that's how I'm compensated. Make sure that I make those decisions. So when I'm judging what the portfolio manager does for each one of those asset classes, all I have them do is earn beta. I feel if they can earn beta, they'll do fine. Now, they're incentivized to earn excess return on top of that, which is great, and that will flow through security selection effect, right? So you get the allocation effect, security selection effect, manager selection effect. You can still be accountable for everything, but what I really own is the allocation effect. And that being said, I don't feel like I've missed out on anything. Like I said, my strategic asset allocation is very long-term. And when things are in the normal part of the distribution, like 1 plus or 1 minus standard deviation, I don't really do much. It's just noise, all right? I mean, you could be right, but to me, it's just luck. There's white noise in that. When things get interesting is when you start approaching -2 standard deviations or +2 standard deviations. Then I get a better sense that what I'm going to be doing actually has a higher probability of success than just white noise. And that's when I start getting excited. And to be fair, at this time right now, with a sell-off in equities and obviously the rising rate environment, I'm getting excited about some opportunities. So we are seeing some structural things going on in the market that just don't make sense. I just put a huge trade on, which took the opposite side of the UK banks in real rates. So I think we were the largest player. I think we bought 400 million of real rate DV01 against the banks that we just monetized last year because everything blew up, right? But those are the things that we like, right? Because I have a long time. I look at some structural imbalances. I can throw real money at it, and I can be patient with it. I don't have to announce to my shareholders at the end of the quarter, how'd you do in terms of your EPS? What was your trading book like? As long as I can control the cost and the bleed of those strategies as I put them in, I can be patient and wait for things to play out. And that's a prime example of what we're able to do in the UK and the real rates.
And Corey, you're more quarter to quarter, right?
Yeah, it's a very different game for me. A huge amount of my time is spent building portfolios for advisors. And so by definition, there's a huge amount of constraint there. For the most part, I can only build portfolios out of ETFs. I can't use explicit leverage. I can't use derivatives. A lot of the interesting stuff that might be opportunistic, I'm largely unable to do. From a behavioral perspective, I am expected to really only rebalance 6 times a year. If I trade more than that, the advisors I work with start to get upset with me. So there's very real constraints that I have to navigate. Now, if you listen to the last panel, what they said is there's now 3,000 plus ETFs. And was it a third of those have come to market in the last 2 years? There's a huge amount of turnover, but there's also a huge amount of innovation. And so 2 or 3 years ago, the types of portfolios I wanted to build, which ultimately try to replicate a lot of what's happening in the institutional space and bring it downstream to advisors and the mass affluent, weren't possible. You just started to see ETFs that included convexity. Now they're much more popular, and thanks to Simplify. Alternative investments really didn't exist in an ETF wrapper, or in my opinion, exist very well. you're starting to now see things like managed futures products come to market that I think are well designed. I still think there's a lot more to be done in that space. And ultimately, the constraint is around the entire community that needs to be tapped to bring an ETF to market. It's not enough to just say, I want to start trading futures. You need to make sure that it's a product that can get seed, that can be liquid, that can be traded by market makers efficiently, that's going to pass due diligence and be available on different platforms. I probably have less leverage than it would have if run in a hedge fund structure. Is it still attractive from an absolute total return perspective with less leverage? All those sorts of constraints are really important. But we are seeing, as beta has been washed over several times over by ETF sponsors, we are now seeing niche sponsors move into much more interesting space. And I think that's where there's real opportunity to, again, take the style of trades, at least conceptually, of what's happening in the institutional market, and bring it downstream to allow individual investors and advisors to build more institutional caliber portfolios.
On the topic of the portfolios that you're building, you employ a concept called return stacking. Can you explain a little bit about that?
Yeah.
And then, Roxton, maybe how does it translate in the institutional portfolios?
So return stacking is a name that a good friend of mine, Rodrigo Gordillo at Resolve Asset Management, came up with. And it is nothing more than stealing the concept of portable alpha, which has been in the institutional space since, I think, the 1980s. PIMCO really started it back then, and trying to bring it to advisors. And the core concept of portable alpha is to use what are called capital efficient exposures, things like swaps and futures, to gain access to beta. So instead of buying the S&P 500, you might put a little cash aside, buy S&P 500 futures, and then use the rest of your portfolio to invest in more attractive alpha opportunities. So what we have seen come to market is there are now levered ETFs that you can employ to get this capital efficiency. So for example, there's an ETF that's a 1.5 times levered 60/40. If you put 2/3 of your money in that ETF, you now have the equivalent of exposure as of 60/40, but you have 1/3 of your money left over in cash to do with whatever you want. So if you were to take that cash and say, put it in gold, and you were to x-ray your exposures, well, your net exposure would be a 60/40 plus the excess return of gold on top of that 60/40. And so what we're trying to do is use that concept of stacking returns together to allow investors to maintain the strategic asset allocation profile they're comfortable with, but fill in the gaps, particularly with inflation, of the risks that they're really naked to. So for us, a huge part of the portfolios we build is using that capital efficiency to get that strategic core of stocks and bonds, and then overlaying it with managed futures.
Yeah, I think Corey said it exactly right. We look at it as portable alpha, the old portable alpha. One of the ways he explained it, obviously you use futures, it frees up cash, and then you can port investments in other parts of your strategic asset allocation to get an exposure, either strategically or tactically. The other way I look at it, though, is just being efficient, which Corey mentioned as well. It's just the efficient use of capital. We have a huge fixed income portfolio on our books, obviously, because we're LDI, and that's your best hedge against your liability. But because we have that, we use that for everything. We collateralize everything off of that strip mandate. So I'll run a $12 billion tail hedge portfolio, zero funding. There's zero funding cost on that for me. Now, obviously, you have the mark to market, but it's not costing me anything to run that program. I run a 27 million duration overlay to complete a duration profile that I have. Zero funding cost. It's all collateralized by my strips or my treasury mandates. So that's another way I look at it, is use your strength. You have real money and you want to be as efficient as possible with your collateral. So if you can create these strategies, these overlays, or these completions, either into tactical or strategic asset allocations, by using your capital more efficient, that to me is also, I call it, return stacking, or just being really efficient with your portfolio.
Okay, we'll touch on collateral in a minute, but since you brought up tail hedging, what's your view on tail hedging? How do you use it? How do you know when you want to hedge something, or if you should just leave it alone, not have that exposure at all? Is it ever acceptable to go to cash rather than hedging? And then when you have those hedges on, how do you know it's the right time to monetize or roll those positions?
That's a lot of
A
questions.
lot of questions.
A lot of
That's a
questions.
lot of questions.
Yeah.
You
want
guys
to
are the
start first?
experts.
Sure.
Tell us.
First of all, I mean, it's funny. People call it tail hedging, but I look at it completely different. For me, it's a way to monetize some money when the market's fearful, so I have some cash that I can put back into the market to earn a higher compounded annual growth rate. That's the way I look at tail hedging. Sometimes you got to sell it to your investment committee as a de-risking tool, but that's certainly not how I look at it. And if you look at tail hedging, it's super complex and doesn't work all the time, right? So you can't say, I'm going to go in there, I have this one strategy that I know is going to be great during this tail event. It depends on the tail event. It depends on the path dependency of that event. So it's really important to have a really diversified set of tail strategies. That being said, we always look to hedge it because we try to keep it as cheap as possible. So we're not going out there and saying, let's buy some out-of-the-money puts, plain vanilla puts, and let's hedge it. I mean, I think everyone knows that's just too expensive. You're playing implied volatility on these things of 100%. That's something I'll never do. So what we do is we try to be smart about it. We'll take cues from the OTC market, like as an example, a variance swap. What am I concerned with? I don't really care about up variance that much, but I do care about down variance. So what do I want to do is I want to create a synthetic down variance strategy to protect my portfolio. That's delta hedged. And that was one example of how we use these strategies. So they're delta hedged. They're delta hedged from a skew perspective. So it's a 1 over K squared. So it's not your normal Black-Scholes delta hedging mechanism that you use. But you can really cheapen up the cost of your tail hedges. And if you apply that a framework, you need a framework that needs to be applied to it. I think our all-in cost over the last 5 years of running our tail hedge program actually has been a positive carry. Because we do things like delta hedge it daily and make sure that we eat the skew convexity. Skew could be moving around on the tail, flat at the spot, and every day I'm rebalancing my delta gamma to capture eat that gamma. So there's a bunch of things that we do to try to cheapen it up, but still maintain during a sell-off enough vega and gamma for it to be worth it.
Yeah, so
I think hopefully that answered all your questions.
Yes, and Corey.
Yeah, I'll try to remember what all the questions are. I'll start 30,000 high level philosophically. My view is that you shouldn't be able to just tail hedge everything and still earn a positive risk premium, right? You're earning a risk premium in assets like equities and bonds because you're bearing risk. So if you throw a tail hedge on and you eliminate all your risk, all you've really done is very expensively replicated the risk-free rate. So first and foremost, you have to think about what risks are you willing to bear. And so for me, a lot of the tail hedging is around first acknowledging, again, the portfolios and the advisors that I work with have for years used bonds as a positive carry tail hedge. They've gotten the flight to safety benefit with treasuries. It's been a great positive carry trade. It's been negatively correlated. The big open question is, will that continue? If it doesn't continue, as correlation goes up, portfolio volatility will go up. And so one of the questions is, if the portfolio volatility goes up, what sort of negative tail events does that now potentially introduce into a client's retirement plan, and how does that affect their ability to stick with the plan? So the way I tend to think about the tail hedges is, what are my knockout conditions? Like, what am I willing to give up return to make sure that if that specific path dependency happens, my portfolio doesn't blow up? I mentioned that we do this concept of return stacking. It is a colorful way of saying we use leverage. That's what portable alpha is. That's what return stacking is. The worst case, leverage introduces a whole lot of potential path dependency because you have to make sure collateral's available. So one of the things you want to look at is saying, where do I get in the most trouble? Is that where I'm getting my risk premium compensation from? If not, that's what I want to hedge out with my tail hedges. So that's really how I think about tail hedging. I think not just tail hedging, but hedging in general, I think is going to become much more popular, again, if bonds continue to prove to be a difficult way for people to manage portfolio volatility. If they no longer serve as the dampener as they once did, I think people will start using things like options. But there's always sort of the certainty, cost, convexity trade-off. It's this triangle, and you can sort of pick two, and the third one is chosen for you. And you have to keep that in mind when you're doing the tail hedges. I think Roxton is absolutely correct that the monetization of those hedges is really important. Without the monetization, you're smoothing your path, but you're never going to generate any excess return. And the monetization is really, to me, all about protecting that path where your portfolio can potentially blow up, but then giving you cash to deploy when the rest of the market's on fire. That's when there are true opportunities. And so without any consideration of the monetization, you just get an equity curve that's slowly bleeding you out, unless you're Roxton and you have, I guess, a way to make it zero cost, which we'll talk later.
Yeah, well, I get that. And to your point, I mean, returns. You're looking at first principles. You hedge. Naturally, you're gonna have to suffer on the return. But if you take it one step further and look at the risk return, the adjusted risk return of a hedge, it doesn't have to be negative, and that's the way we look at it. So everything that we do is structured by looking at the underlying exposure that we're trying to hedge. The objective is not to reduce the Sharpe of what we have on the underlying exposure by adding the hedges on within a given tracking error. So everything is modeled that way, and the hedges and the tail risk strategies that we choose fit in that model. And so we do believe you can give up return, but just like currency hedging, it's there for not only to increase or decrease return, but to dampen the volatility of those asset classes, to give you a risk budget to apply elsewhere within your asset allocation. So just want to be clear on that.
Okay, thank you. Let's turn our attention overseas. We have a very strong dollar, rising rates, increased brinkmanship globally in a number of spots, civil political unrest in some emerging and frontier markets. How do you think about the international opportunity set? How do you sort of parcel that out? What form do those investments take? Emerging, frontier, and developed international markets, and then public, private. How do you execute those opportunities?
Everything I have to do is public. So everything's got to be able to be wrapped up in an ETF, and that's what we're ultimately delivering as portfolios of ETFs. So we're stuck in the public realm, and I would also say, again, we're constrained by appetite. In the US, the advisors that we deal with have clients who tend to have a home country bias. They want more US exposure. So we tend to skew slightly more US than international and emerging. They do want that international and emerging exposure, though. And there's really not a lot we do to add a tremendous amount of color there. I will say on the emerging market side, I personally feel as a portfolio manager, there's a lot of tail risk with the types of countries that are very large in the base indices. So we skew towards products that will avoid some of the dictatorships, because I think there's a lot of tail risk in trying to centrally plan an economy top down. So we try to, there's a product out there that freedom weights the emerging markets. That's the product we use in our portfolio. So that's probably the biggest tilt we take. I am personally very interested in currency hedging. I will say this is one of the ebbs and flows of managing money for other people. Currency hedging got very, very big with Wisdom Tree's products in 2015. And then I think the entire industry got burnt by them, and there's zero appetite for it. But I think from a purely theoretical basis, it's been decently well proven that if you're going to hold international equities, sort of 50% currency hedge seems to be the right balance, and you'd certainly want to currency hedge international bonds. The appetite for putting that in portfolios today, though, is astoundingly limited. And so I have to sort of, I hate to say it, but dance around the needs and wants of the advisors who don't want to see that exposure right now. If the strong dollar continues, I would expect some of that appetite will return. It unfortunately is performance chasing in many ways.
Right. And Roxton, how do you guys think about it at UPS?
So strategically, our mandates, our benchmarks are global. So we use, for equity, it's the MSCI ACWI IMI index. We do have some emerging market exposure. We have some frontier exposure as well. But I pretty much leave that to the equity PM. I don't really take a lot of tilts in that market. I'm very happy just earning the beta and being able to explain it that way. I'd say the only thing that maybe that I add on, or where the markets are able to give me that exposure, is dispersion type trades that I see at a euro or on the Topex in Japan. We'll put some dispersion trades on, and maybe some carry trades that we think that make sense. We never go naked carry. That's just not in my mandate, so it's always protected. But we will sell volatility from time to time, as long as we're protected on one end with either a realized or an implied realized hedge on that. So I'd say that's as far as I go on that. I don't really touch those decisions on it so much.
Okay. Where do you see asset bubbles brewing, and how do you stay the course or navigate around those?
I'm not sure if I see any asset bubbles explicitly today. I will say, just very candidly, that the big thing I'm still scratching my head about is equity valuations, given the returns you can get in corporate bonds today. The forward projections for equity returns are barely, in my opinion, giving you a premium above intermediate term corporates that would really justify taking all the potential extra risk. Now, my calculus on trying to back that all out could be exceptionally wrong, but I struggle to see how equity markets are correctly pricing in an attractive premium, given how attractive I think credit and just frankly treasuries have become on a nominal basis. Now, the real return question always hangs out there, but I do think my concern is less about bubbles, just more, why have equity markets not fallen further? They have, at this point, merely just, from everything I can tell, reacted on a rate basis to changes in the discount rate, but really have not moved from an earnings basis. And so if there is another leg down, that seems like the most likely place, but I struggle to see now, from a relative attractiveness opportunity, why someone would be heavily overweight equities versus corporate bonds.
So how long does it take to reset the equity valuations?
Well, it can go very quickly. It just depends on how the market moves. I personally think we're in a market environment right now where you have, like, there aren't the levered players that existed pre-March 2020. When I look at March 2020 with all the beautiful benefit of hindsight, you have a tremendous amount of simultaneously levered players who were forced into this unwind, and so you got this market feedback loop of high volatility. Most of those players were either burnt out of the market or just carrying much lower leverage today. And so there's nothing that really forces the market to sell off other than just, sort of stubborn real money investors putting less money to work or taking their money out. And that's a slow process. I think fundamentally, we're in an economic cycle where everyone's looking towards central bank behavior. And if central banks are quote unquote data driven and that data is coming out on a continual basis, there's only so far the market can move before it has to wait for the next cue from central banks. So I think we're there's nothing that's going to force the market to make a violent move in either direction, because there's no one who's dramatically over or under levered. And I don't think that from a fundamental perspective, we can sort of outrun or look past what central banks are doing over the next quarter.
Roxton, any?
I could be full of shit, though. Most likely am.
Any asset bubbles that you're concerned about?
I can't think of anything off the top of my head. And as I aforementioned, I really don't like to act unless I'm reactionary. Mm-hmm. So I don't like to forecast. I'm a very terrible prognosticator when it comes to this stuff. I'm always wrong. So I'd rather wait till something happens and then be reactive, because then I know I'm in a better place from a probability perspective on the moves. But I from what Corey was saying, I tend to agree with him as well. I think there's been a lackluster move in equity. I don't know if I'm interested yet, because I haven't really seen the fear flow through the market yet. The VIX index, hit a high of 38, 39, mean reverts real quick back down to 20. It just doesn't really feel like there's been a lot of fear in this market yet. I agree with Corey on the retail side. I also think a lot of it is dealer flow as well. Dealers have a lot of options, and when they're selling a lot of these put options, dealers are, the only way to hedge that is to delta hedge it. So at the end of the day, they need to go in there, and if the markets came down, they have to buy a bunch of delta. They went short, they sold all these options, so they have to go back in, and they use the futures markets to buy a bunch of delta and typically push it back up. And I think we could be in that situation now where there's enough protection on there where the dealers are hedging their gamma profile. And I'm just waiting for that to release, because at some point it will release where they're not going to be able to go back in there. There's going to be enough pressure on the skew on the downside of volatility that's going to exacerbate everything, and I think that's when then I will expect to make some moves and where things may get interesting.
So we had Mike Novogratz here earlier. What's your view on cryptocurrency's place in your portfolios? And if you believe in it, how do you execute that?
It's something very hard for me to invest on behalf of my clients because there's very limited product out there that provides access. I personally, in my personal account, dabble. It's a small amount. It sort of ranged. It was about 1% of my portfolio, got up to about 3%, now back down to 1%. It's hard for me to say whether ultimately crypto is a positive or a negative, or it's sort of overrun its value, or it's undervalued. There's so many projects that come and go. The space is moving so fast. What I do know or do believe is that there has been so much intellectual capital thrown at it that it's hard for me to think that nothing will come from it. I can't think of another example in human history where as much intellectual capital has been thrown at something that zero has emerged. So I don't know if Dave mentioned it on the last panel because I had to run out and get mic'd up, but Dave Nattig and I were talking at dinner last night saying that he's a real believer that the next step beyond ETFs is tokenization of assets and strategies, and that'll all live on the blockchain. So instead of buying an ETF, you will buy a token of that ETF, and a huge amount of that process will now be T+0 or instantaneous settlement that'll all occur on the blockchain. Your access to leverage will be much more competitive. You don't have to go to Schwab and pay them 10% annual to get leverage anymore. It's much more competitive peer lending. And that might take 15 years to play out, but it would be massively transformative for our industry, certainly. So I think it's very interesting. I like to keep my pulse on it. For me to keep my pulse on it, I have to dabble in play. I don't know if there's any great way for an institution to necessarily get involved. And I have heard some institutions that do, but from a fiduciary perspective, it becomes very, very difficult, particularly when you're talking about KYC rules and you don't know who your counterparties are for a lot of this stuff. And there's all sorts of hacks and custody risk. And until that all gets sorted out, I think it's very hard to really introduce it in a meaningful way to client portfolios.
Roxton, you're shaking your head. Do you agree?
I absolutely agree. I mean, I don't think I'm qualified to opine on whether I think it's a real asset or a store of value. I'm not smart enough, and I haven't really done enough work to really look into it. It's ever changing. But I will say selfishly, it'd be very hard for me to include that in my portfolio. Just because of the KYC, the compliance that I'd have to go through, and I'd have to explain it 15 different times to 15 different people. And then you're opening yourself up to who knows what, right? Things go bad and it goes from 20 down to 9. Did I introduce something that I should have knew had these inherent risks in it? And they didn't understand. So like what Mike said, I think you got to wait until it becomes mainstream, until it gets viewed as a TV tube and everyone uses it. And then when everyone's comfortable with what it actually is and what it's doing, then I would have no problem introducing it. But right now, I just think there's way too many risks associated with it. And myself as a fiduciary, I just wouldn't be comfortable introducing that into my portfolios at this time.
Okay. Let's go back to Collateral. Roxton, can you comment on what happened in the UK? How does that affect your business? Is there some risk of contagion here?
Yeah, that was an interesting problem. And could it happen in the US? Yes, but it's completely different. We manage LDI in the US very different from the way it's managed in England. And at a high level, a lot of the English pensions, or the schemes that they call them, are invested in commingled levered vehicles in order to get their LDI exposure. So the government says you need to be hedged and you got to do it with gilts, but there's not enough gilts out there physically for everyone to buy it to get the effective hedge ratio. So what they did was they created these commingled funds that are levered up, and they said, here you go, we'll lever it up 6 times to give you the exposure you want, and everything's great until rates blow out 200 bips and there's margin calls on the commingled funds. And that's exactly what happened in England. We saw that, and I saw the pressure that it was putting on real rates, and that's the reason that we put the trade on. It just didn't make any sense, and we knew that it was at some point, we didn't know when, was going to blow up and mean revert. In the US, it's very different. We don't do commingled vehicles, at least not the bigger pensions like us. We have separately managed accounts that we run that are direct. We own the bonds through a QPAM or qualified pension asset manager. I don't think, well, I've been fortunate enough to be at the two largest pensions, both General Motors and UPS, where we actually owned all the assets outright. There may be some smaller pensions that don't. But it's a completely different model. But you could still run into a problem. Obviously, like I said, I'm highly levered on my duration overlay that I have with my liability. And to be able to run programs like that, any kind of leverage program, you better have a really good liquidity management program on the other side. Otherwise, don't even start getting involved in it because it's going to blow you up. So parallel to whatever we do from the derivatives and overlay space, we have a liquidity management program that's been really thought out, and we can understand where the risks are and the liquidity sourcing that we'll need in order to continue to run the program. And like I said, in the UK, that just wasn't possible because they just did not have the physical gilts to comply with the mandates that the government put on them to be hedged. So it was almost they created the problem themselves. It's a shame, but it's a very different situation in the United States.
Can I ask Roxton a question?
Yes.
Because I have a follow-up to that. So I think Matt Levine at Bloomberg wrote a great article about this, talking about how through the use of leverage to hit these hedge ratios, pensions have ultimately introduced a huge amount of path risk. That their greatest advantage was that they really only had destination risk. You know you have this long-dated liability. If you could buy all the bonds and immunize it, great. But once you start to introduce leverage so you can use your risk assets more productively and meet your funding status, you introduce path risk, right, and risk those collateral calls. One of the things we do see in the US and have seen is that pensions have decreased or seemingly decreased the amount of liquidity they have by increasingly moving into private investments. And so is that a potential area of risk for when they're trying to immunize using derivatives and they get capital calls and they can't rebalance because they have a huge amount of private illiquid assets?
That's a great question, and that is true. I mean, in an asset, if you think about a pension, you can look at it from two different perspectives. If you're managing the pension, you're looking at it from an assets-only perspective, and then when you're looking at it holistically, you have to look at it from an ALM perspective, which is both liability and assets. And what they're doing to earn return is, well, I don't like volatility, and I like return. Let's just invest in a bunch of private assets because we get both. I get this beautiful return, and I have this dampened volatility, albeit fake, against my assets, and it makes me look great. So they're increasing the allocation of these private assets, and they say, oh, by the way, I don't like rate risk either. That introduces uncompensated volatility, so let's just hedge all that out. Oh, wait, but we have a bunch of privates. Let's just do it in derivative form. And that's the recipe that you're talking about. It's disastrous, right? Because then if rates go up and you have a liquidity call and you have nothing liquid to sell to be able to create that liquidity for your derivatives management, you're screwed. And then you're a forced seller of this private, you're going to get out very bad marks, and it just creates a big mess. I mean, we ran into the same problem. I run strategic asset allocation through a stochastic mean variance model that we created in-house. And if you just let it run on itself, it would say 60% private equity is what you should get. To immunize your liability, that's it. You're beautiful, you get your return, your dampened vol, everything's wonderful. I had to actually take that and put a governor on it and say, I understand why it wants to load on private, but we loaded and we brought it down. We gave it a haircut by almost 1/5 to what the allocation said for the reason of exactly that, liquidity management. So really, really good point. I think a lot of people are feeling that pain, but it's something that certainly pensions better be cognizant of because it could pose a problem.
How do you view ESG? What's the impetus for putting an ESG mandate in your portfolio? Are clients asking for it? Is it the right thing to do? And then when you think about quantifying whether that's a successful strategy or not, what's the right time horizon? And how do we measure that?
Well, I know Europe is really far ahead of us on this stuff. I know MSCI came to my office in 2012 and said, hey, you better get on this ESG thing. It's the next big wave. And I said, okay, bring your best ideas. And they had 5 people show up with binders this thick of every variety of ESG strategy you could have. Filters, screening, tilts, it doesn't take much to run an index once you have all the data and tools. So they had every variety of index you could think of. And it sort of highlighted the exact problem of ESG to me, which is everyone's definition is different. So for us, we've let it be a client-driven conversation, and so far I have had 0 clients ask me for ESG. It just has not been a priority. I do think that there's very good discussions around what does it actually mean for market participants to express a preference for different securities. What does that potentially do to the return premium they generate? If everyone is changing their utility function to want to own those assets, well, in theory, SIN stock should potentially go up, but it also changes potentially the cost of capital for those businesses. So there's trade-offs to consider here as to whether ESG is just an expression of a preference or whether it actually flows through the actual capital economics of the business. I'm not sure I'm qualified to say whether it's right or wrong, but I think those are interesting debates that are happening. But I will say the advisors I talk to have, for higher net worth clients, done things like direct indexing to express some of those preferences, and said it creates really sticky clients for them. But for us running ETF model portfolios and strategic allocations on behalf of advisors, we really haven't seen any demands to introduce ESG style ETFs into those portfolios. I think by and large because a lot of the product that is out there doesn't necessarily express consistent views with what the clients want. It might, one client might be, pro-oil but anti-gun, and there's no ETF that's going to give you that. So a lot of it ends up being so personal to the clients that they end up expressing it in an SMA, and that's just not what we can deliver with ETF model portfolios.
Roxton, does ESG have a place in your portfolio?
I'd say a simple answer is no. As a fiduciary, my objective is to earn returns at the highest risk in the most efficient way possible. Until ESG can prove to me that they're not going to dampen my returns, or from a secondary or tertiary effect show that they can outperform what I currently I'm invested in, I could care less, right? So I can't go to my fiduciary and say, yeah, we underperformed by 200%, but hey, we did great for the environment. They're not going to be happy, right? They're going to want they want their retirement. So my main goal is to earn return until I think or understand how ESG plays in and flows through the economics of return better, or if it even does. At this point, I don't think there's even any indications or proof that it does. For a lot of the reasons is no one knows what it is, right? I mean, what is it? Is Tesla an ESG company? They make electric cars. Why are they not in the index, right? It makes it, why? And I think the whole thing has gotten political, and I stay out of the politics on it. And I think it was a great marketing thing because I think it created a lot of money for a lot of consultants out there. But to be honest with myself, no, I could care less unless there's a reason for me to feel like the returns are economic and going to flow through to the investments I make. I don't consider it.
Okay. Corey, you've done some work on market structure. In fact, there's a long paper on your website that's available for people who are interested in reading a little bit more about that. But can you talk to the pace of investment decision making and how changes in market structure impact your decisions?
Sure. Where's Mike Green? I should just have him up here and he can give the spiel for me. There's a paper I wrote a couple years ago called Liquidity Cascades, post-March 2020, talking about some of the endogenous effects that I felt I saw in the market during the crisis and trying to dig through why that might be. Mike was heavily influential in the part of the paper that was really about the effects of potentially passive investing, as well as just ETF index investing, the change of market structure of how cash actually moves in the industry, from mutual fund managers historically getting to pick and choose what they buy, getting actual cash in and cash out, versus what's happening with basket trading and electronic basket trading with market makers, how that actually affects the way correlations appear in stocks. Big 30,000 foot view was a lot of the narrative of the paper was it's this sort of loop that all works together. You had central banks acting as the lenders of last resort. They were coming in to prevent crises. In doing so, they were suppressing interest rates, creating this Tina effect, forcing investors up the risk curve. You saw this in the types of assets that everyday investors as well as pensions and endowments were being forced to buy, moving into increasingly illiquid, higher risk positions. They were also finding other ways to harvest yield. So volatility, risk selling, risk premium selling, that sort of stuff that introduced more derivative effects, which Roxton talked to, the dealer effects in the industry, and ultimately pushed a whole lot more pro-cyclical leverage. So you had all these sort of volatility targeting strategies that got used to manage futures, risk parity, that were self-reinforcing. That as vol dried down, they would lever up, potentially drive markets up and vol down further until it got to a point where there was some sort of exogenous shock that would cause a big sell-off, a massive unwind at the same time, and the Fed would have to step back in. So that was the Liquidity Cascades paper. It went insanely viral for our industry, which was sort of surprising because, as I say at the beginning of the paper, like, I'm just going to tell a story. I'm not going to tell you whether I believe it. I've still never told anyone whether I believe it or whether I think I'm full of shit, but it was a great story, I think, with some pretty pictures in it. But I do think there are some market structure questions we have to start asking, and academics are really starting to clue into them. Like, one of the most interesting papers I've read in the last 2 years was about the effects of target date funds. Something we don't think about much as an industry, but in the early 2000s, that was a sub $10 billion industry. That's now a $4 trillion industry, right? And so you sort of have to ask the question, what are the impacts on markets when you have these very consistent flow of retirees into a product that's following a defined glide path that has no view on the relative attractiveness of the assets in the glide path? And the paper said there's two effects that they picked out. One, the correlation structure between stocks and bonds was getting systematically reinforced at the point of rebalancing. And two, stocks that were included in the equity indices were behaving differently than the stocks that were excluded. And there were actual inclusion-exclusion effects. And so you're starting to potentially see that when people stop caring about trying to price securities and are just blindly buying a product that's following a market cap rule set, you are potentially seeing price discovery break down both within asset classes and across asset classes. Now, do I believe that the markets are totally fundamentally broken? I have no idea. I don't know if we will ever know, but I think we are seeing a growing amount of literature that says flow creates impact. In the past, that was not accepted as being true. It was flow created noise, potentially, and that noise would be wiped out by informed traders. And no, in fact, what we're finding is actually flow can create permanent impact in prices today. And so I think understanding ownership is more important when you're talking about security selection. Understanding how different strategies behave, understanding the macro picture of who's levered in the industry and who's going to be the player who's forced to unwind, I think is of growing importance. And I think all of this plays into potentially creating fatter tails. And I think that's something we've seen statistically. If you plot sort of measures of fat-tailedness in equity markets over the last 20 or 30 years, it's gotten increasingly higher and higher. So whether that's a narrative to fit some data that's actually noise, I don't know, but I think this is an area of growing academic interest, and all of the papers coming out in the last year are suggesting that these flows that we largely ignored, at least academically ignored, practitioners never ignored, are actually having a profound impact on the way markets work.
Roxton, is this a feature that you can take advantage of? Understanding flows and how and market structure changes.
Yeah, understanding the flows, again, it's really hard to quantify. And we're so long term that for me to go in there and tactically adjust based on inflows and outflows is something we look at. I mean, that's interesting about the target date funds. But the other thing we look at that really creates a lot of liquidity is the options market. There's a lot of talk about, the futures and the Delta One markets are nothing more than the tail of what's actually going on in the options market. And you see that because of the liquidity and the liquidity book that the options provide. You go to a bank and you're going to buy a put or a call from them. You just created a limit order book on their desk to Delta hedge. If you go in and you sell a call or sell a put, You just created a stop order book on their ledger, which takes away liquidity. So just by the matter of where you're hedging, the option book itself creates liquidity. And we watch that. We look at the gamma profiles. We look at the Vanna profiles. That's why we monitor on a daily basis. If you see a big sell-off on the market, 9 times out of 10, it's going to mean revert at the end of the day because the dealers now are short delta and they need to cover it and they're buying back delta and they're going to go into the futures market. So you see that a lot, but it's really, even though I monitor even that once a day, which I feel I have some pretty good data on, because I have a relationship with all the banks, so they'll give me all their gamma and their Vega flow. So I have a good sense of what's happening. It's so hard to take advantage of. So even something like this, I think would be equally as hard. But I think it's something you've got to be cognizant of because it explains a lot. And if you can explain and understand something, maybe there is something you can do about it in the future, as opposed to just saying, well, why did this happen, or something along those lines.
Yeah, I'll say for me structurally, I have friends who work in hedge funds who try to exploit these effects. I don't think there's something that can be wrapped up, say, in an ETF and delivered to advisors necessarily. So for me, I have to take a big step back and say, okay, if I think this stuff is happening on a micro or macro level, what does that imply for the strategic asset allocation I want to build? Well, for me, I do have confidence that there are things that potentially are creating more fragility in the tails, that I expect to see more tail events. And so for me, I am searching for products that can introduce convexity in the tails, both up and down in the way we manage our portfolios. And so 5 years ago, those products didn't exist. They are now coming to market, and you can find ETFs that have embedded convexity in them and use them in your strategic asset allocation. And so that's something we've embraced wholesale in the way we build portfolios.
I like that. We have 1 minute. What are we going to be talking about on this panel 1 year from now? What is a trend in institutional allocation that will be discussed over the next year?
Given how much everyone is starting to love managed futures today, I suspect it's why is everyone hating managed futures. That's just the way these cycles go. I know from my perspective, I don't think the trend will change. Josh Wolf was talking today about sort of, what did he say, the trend versus the noise, finding that arrow. Well, the arrow in ETFs today is continued innovation, finding the blue ocean, which is derivatives. And so I think we'll continue to see really interesting derivative positions get packaged up within ETFs. And the question then becomes, how do you introduce them either tactically or strategically? I think we will continue to be asking this question about persistent inflation volatility. I don't think that's going to go away and what that implies for a strategic asset allocation. And I think the more that creates pain from a portfolio volatility perspective, the more advisors are really going to start to ask the question of, do they want to stick with that 60-40, or do they want to take the business risk and move off it?
Yeah, along the lines of the 60-40, maybe the question is, what happened to the correlation between rates and equity? Why isn't it behaving the way it should? So we may be in a situation where you have rates continue to go up, equities are selling off, and it could create a lot of structural problems. We may be talking about that next year.
Okay.
So we may be in a shift in regimes of that correlation.
Excellent. Thank you both so much for joining us today.
Thank you.